Hi, and well, I've not gone absolutely mad. This video, we're going to be looking at the Santa rally, or Santa crash, and what history tells us about December volatility. Now, every year traders hope for the so-called Santa rally. Some of you that have been in the markets a while may well have heard of it before. It's a festive surge in the stock market during the last week of December and the first 2 trading days of January. But history shows that December is not always bullish. So let's have a little look at the data, and are we heading for a Santa rally or a Santa crash? So hopefully that makes a little bit more sense now. Well, over the past 25 years, a Santa rally has happened in roughly around 70% of those years. Since 1969, the S&P 500 has historically gained around 1.3%. Now, according to Stock Traders Almanac, that outperforms most other weeks of the year. But when you look at the entire month of December, results are quite mixed. Let's have a look at a couple of examples. In 2002, the S&P dropped nearly 6%. That's the S&P 500. 2018 was one of the worst Decembers on record, down about 9%. And in 2022, the market fell by over 6%. Now, if we look at historical monthly returns across a broader data set, December shows positive returns in 70 out of the past 97 years, but it still leaves plenty of room for volatility. Now, we cannot deny that seasonality exists, but macro conditions often dominate this calendar effect. Now, there are 3 drivers why December occasionally turns into a Santa crash. Firstly, hawkish Federal Reserve policy. Sounds a little bit familiar. Secondly, we've got tax loss selling as investors close long positions out towards the end of the year. And finally, we've got low liquidity, which amplifies large orders and market volatility. Now, to gauge whether growth is possible in December, we can take a look at a few other factors as well. Now, the Fed's tone at the December meeting. That's going to be really, really important. Now, according to FedWatch tool, as of the 28th of November, there is an 85% probability of a rate cut, but forward guidance will matter just as much as that probability. So what they say could have a key impact for the last couple of weeks of December. US Treasury yields tend to be an important macro signal for equity markets. If Treasury yields fall, it could increase the chances of a Santa rally. And the performance of tech stocks may well matter. We know how important they are at the moment. If tech is weak, a rally could become less likely. So yes, we have to say the Santa rally is a real seasonal pattern, but December can be calm or extremely volatile. Now, history reminds us that we can hope for gifts from the market, but risk management is still the best present a trader can give themselves. So volatility can be high. Don't forget those risk management techniques. Let's see if Santa comes a-calling. Bye for now.